Okay, it's Tuesday the 29th of November. It's just gone 11 o'clock in the evening here in the UK. And today's trading is this red and green candles that you see here. So that's the London, so the New York Open. This area is the London Open. You can see how flat it was around that period. So very difficult to see any form of trade that we could take on a higher time frame, but it was that. If we drop into the 5 minute, just before we get into New York Open, we have this this area where we have, bring it on, get rid of this, redraw it. We have a small fair value gap just by that, with the convergence of I've done it again, bear with me, of a swing low. So in this area we have a high, a low, and a higher high. So that's our market maker buy model just before we go into New York Open. So as price comes back down, this candle takes out the swing low, so that's our breaker, and that forms the beginning of the market maker sell model. So I really should have done that first fractal in green to distinguish between the upwards movement and downwards movement. But you can see how as we broke this low just by here, which was formed by the convergence of the fair value gap and the swing low, we have our market maker buy model gets broken. We have this this other fair value gap just by here. And it goes straight into the New York Open with the first phase of distribution on the market maker sell model. So price comes up, wrong colour, jeez. We have our first phase of distribution, followed by our second phase just by that, and goes all the way down. So all in all, if we took a trade, so if we look at just place a fib on the dealer's range, which would have been from here to here, you can see how price comes up into the premium of this specific dealer's range, and then just carries on going down south. So from this entry point, 5 pips would be here, 10 pips towards the high that we've got. So if we did our 5 pip stop, it's almost 60 to 1. It's about, sorry, not 60 to 1, 60 pips. That's about 22 to 1 trade there. So you can see how that could possibly be really good trading day. But what we can also do is play on this and actually scale in. So how would that work? When we look at the, let's get rid of some of this. So we have our market maker sell model here. As price comes back up, find the right colour now. Initially we get from this high to this low, there is a market maker buy model there, and we stretch this out. We have a break again in structure. And we form a new low just by here. And as price comes back up on this high, we can actually get in on as it goes past the breaker. So we have the potential here for one trade, two trade, and three trades. So if we were to measure that, in total we have, that wasn't supposed to happen. We have a 60 pip trade. That's two 60 pips trades. That's equivalent to 120 pips. And then another trade by here, which is 40 pips. So that's 160 pips in total over three trades. Five pips. You can see how you can quickly scale this up.